In an unusual joint statement, the Bank of Japan and the Japanese government indicated that they might step in if the situation continued to be weak. Hello, and welcome back to our channel. Today we'll be telling you about Japan's economic fall. Stay with us till the end to hear about what can stop the decline. Let's begin by hoping that you've subscribed to our channel. What effects can be seen from the yen's 20-year low? In June of this year, the Japanese yen dropped to levels last seen in early 2002 against the US dollar. The shift size impacts the domestic economy since import prices based on the yen are increasing at a record yearly rate, putting strain on household balance sheets. In an unusual joint statement, the Bank of Japan and the Japanese government indicated that they might step in if the situation continued to be weak. The impact of the weakening yen on larger financial markets has been relatively small so far, but that might change if the sell-off picks up speed. Why is the yen not strong? The third most traded currency worldwide, the yen, is now close to 134 per dollar after beginning 2022 at 115. The yen is on course for its most significant yearly decline since 2013, with the dollar up more than 15% this year. The inferiority mainly stems from increasing interest rate differentials globally. The BOJ has stepped up its accommodative policy approach as the rest of the globe, led by the US Federal Reserve, is actively raising rates to rein in skyrocketing inflation. While the difference with German yields is at 8-year highs, the difference between Japanese and American 10-year government bond yields is 279 basis points, which is close to a 3.5-year high. Will the government step in? Indeed, they suggest that they might. The greatest warning so far that Tokyo could interfere came from the Japanese government and central bank in June, when they expressed alarm over the most recent significant drops. Although the yen immediately recovered from its two-decade lows, only some are confident that genuine action is probable. Japan has historically concentrated on halting sharp yen increases and moved from a hands-off perspective to yen weakness due to the economy's reliance on exports. This makes it more challenging because buying the yen requires Japan to use its limited foreign reserves, which makes it more difficult. When the Asian financial issues prompted swift capital outflows from the location in 1998, Japan, for the last time, participated in supporting its currency. Before that, from 1991 to 1992, Tokyo stopped the yen decline. Given how challenging it is to modify the yen's value in the international foreign exchange markets, currency intervention is expensive and prone to failure. What can reverse this trend? The BOJ's dovish position may change if the development prospects significantly improve when the nation reopens its borders following COVID and inflation rises. For the first time in 7 years, Japan's core customer rates in April were more than 2% higher than they were a year earlier, reaching the 2% inflation target of BOJ. If the BOJ adopts a hawkish stance, the yen's decline could end, according to the head of currency solutions at Insight Investments, Francesca Fornaciari. Any indication that interest rates out of the boundaries of Japan are at their high could also spark a relief rally. However, given that US rates are anticipated to reach more than 3% in June 2023, there are currently no indications of that. Does a declining yen stimulate the economy? To help Japan's growing trade deficit, the yen has fallen back to recent 7-year lows against the Chinese yuan and is currently reaching new multi-year lows opposite to the Taiwanese dollar and the Korean won. According to some individuals like John Vail, chief international strategist at Nikko Asset Management, currency weakness is crucial for the economy of Japan to preserve its competition as a reliable source of supply chain diversification. The yen's depreciation also increases the appeal of its stock market to international investors, who think it is undervalued compared to the European and American stock markets. Even though they continue to decline as investors around the world sell riskier assets, Japanese equities have outperformed their competitors in 2022. What about homegrown financiers? Japanese investors are in a bind as a result of the yen's decline. Since yields are steadily increasing, foreign bonds are becoming considerably more alluring. However, it also means that the price of FX hedging is increasing. Therefore, Japanese investors can frequently only benefit from the higher rates if they purchased unhedged international bonds. However, investors find it difficult to stomach such currency risks like the rising yen, given the current weak levels. The yield advantage would be erased if we made even a small move back to where we were some months ago, between 115 and 120. Let us know your thoughts in the comment box below. Like and share this video, and hit the bell icon for more such exclusive content. Thank you.